Hey everyone, so I've had a lot of friends lately ask me, is it a good time to go refinance their mortgage right now? And the answer, of course, is it depends. Now, interest rates right now are very low, right? So the Fed cut rates like a half a point overnight, and you're seeing rates in the twos and the threes now, which is insanely low. But if you get with the wrong lender, there are tricks that they have at their disposal where they can potentially recoup some excessive fees that would otherwise mask the true benefit you'd get with a reputable mortgage broker. So I have a spreadsheet here, of course. Um, and I don't think Excel really does it justice. I'll show you a couple other tools I have later in this. But nonetheless, I put together a spreadsheet and I'll show you how I would go about evaluating a mortgage here really quick to see if it's a good deal or not. Um, Now you see I have some text over here on the right side regarding some assumptions and then basically some classifications of closing fees. So really the big assumption we're going to make here is where you want to make an apples to apples comparison with your current mortgage. And in order to do that, basically we're going to evaluate what your monthly payment would be with the refinance scenario. And we're either going to top up or reduce your current monthly payment so that effectively your month to month cash flows for either the refi or your current mortgage are the same. As that's really the only fair way you can really compare them from the standpoint of evaluating is it a good deal or not. Obviously, if you refinance at a lower rate and with a shorter term compared to, let's say, a 30-year at a higher rate, obviously you're going to save some money in the long term. But the whole point of doing the same monthly payment is so that you can really evaluate them more on an apples to apples type basis. So you got a lot of numbers and everything in front of you right now. How would you use this spreadsheet? And I'll share the link in my Google Drive so you can go in and dive in and do this. The most important thing, though, is that you actually enter the right numbers, because if you enter the wrong numbers, you could make a really, really bad decision. So please take care when you're entering your numbers into this. Not my responsibility if you if you end up making a bad decision here. So you got to be smart with what you're putting in to make sure it makes sense. So kind of start up here with your current loan, right? So the thing we're doing here, basically just enter the basics of it. What did you loan originally? For what term did you do it in years? What's your interest rate on it? And then what's your current loan balance? So just enter the four numbers in white here. Everything in gray is computed for you. Now for the refi, slightly more complicated, but not really all that bad. So you'll obviously enter the rate you're seeking, the refinance loan amount. So in this case, you can see I've set it up to be the exact same as the current loan balance. So it's just really a lateral transfer where I'm just trying to play with really the term and the interest rate of the loan. There are things you can do, and I'll show you in a minute, where you could actually refinance more than you currently owe. It's called a cash out refi. If you want to get some cash out of your home to, let's say, go do a project or do whatever, you can do that. Now, obviously, there's going to be a cost to that in the long term. Alternatively, you could do a cash-in refi where, let's say, you want to refinance to a shorter period, but you don't want your monthly payment to go up excessively. If you have extra cash on hand, you can contribute more into the refinance to try to get your monthly payment down. Alternatively, if you originally maybe only put down a small amount on your loan originally and you have some cash available and you maybe want to get rid of a PMI, you could potentially top up to beyond 20% loan to value there with the amount you have down. And that too could effectively pull a little bit off of your effective monthly payment when you factor in the PMI. So you're going to enter the period, your refinance amount, does not need to be the same as your current loan balance, as we just explained. The interest rate, and then there's one of two ways you can enter your fees. So in addition to the interest rate, you got to be careful what they're communicating to you in terms of what the cost of doing a refinance is. Traditionally, one way to do this is to give you an APR. That APR, I'm not going to get into the details of it in this little broadcast here, but basically it's a way to sort of rephrase what the actual refi loan fees are in terms of a percentage. Basically, it's trying to say if you took the loan fees and consolidated them in to the net amount you're going to borrow, what would that additional cost be expressed as an interest rate as opposed to an absolute dollar amount? So like I said, you have a couple options here. In this spreadsheet, you can enter that as the percentage. Typically, it's always higher than what the interest rate you're getting is. The larger the delta between the two, generally the more expensive or the higher the refi loan fees are. Now, if they just tell you what the loan fees are, we can go and enter those. We just have to be careful that we only enter the ones that are non-refundable, which we'll cover in a second. So right now, by entering this as a percentage here, this number in gray is getting computed, and it's based on all this information here. You don't have to worry about it. But if you know what the fees are, you can just punch that in. Let's say they're $2,500 instead. It'll overwrite that. It'll ignore this. This is no longer accurate. You don't really need it. But if you leave this cell blank, it'll revert to using the APR to calculate the fees. You don't want to write any Excel macros or anything. I want to keep this thing simple. So that's how that's mechanized. Let's talk really quickly about what is a non-refundable versus a refundable loan fee. So in this case, we're looking at the types of fees. Non-refundable fee is one where you're not going to get the value of that amount back. So in this case, your origination fees, which are going to the broker and the bank, you never see those back. That's a non-refundable fee. You'd want to tally those up in this amount if they're giving you the actual fees. Same thing with appraisals or inspections. While you may get the report at the end of the day, there's no chance to really recover that money back directly. And same thing with your title certification and insurance fees. They're all services you're paying for. When you do the refi, you're not seeing that money back. Now, there's another class of fees that you may have to pay too when you do a refi. And really those are centered around your escrow, your property taxes, and your homeowner's insurance. So generally, if you're going to refi, let's say you're with a new bank, they're going to want some money in escrow. You may have to put some money down with that. It is going to be due once you execute the refinance. However, effectively, that money will go towards item 2 here, which is going to be your property taxes and insurance. So it's things you're going to have to buy either ways. It's just whether you're effectively paying them today or a few months down the road. So those are refundable in that sense. The last one is a little bit more complicated, and those are mortgage points. So one thing you can do if you want to buy into a lower interest rate, you can effectively prepay interest, sometimes referred to as points. That prepaid interest is deductible on your taxes, but only under certain conditions, of course. So, for example, with the tax reform, I think it's 2 years ago now, there was a substantial increase to the standard deduction, right? It's now called the enhanced standard deduction. So if your deductions in a year don't exceed that amount, then any of this incremental mortgage interest you're prepaying, if you don't get above the standard deduction threshold, you're not going to really get that benefit. So really, if you live in an area where, let's say, property taxes are higher, state income taxes are higher, or you have a very large mortgage amount, Namely Illinois, for example. Sorry to my friends in Illinois. I live in Missouri. Our taxes are low. You guys should all come over here. But anyways, so generally, if you live in an area that has lower taxes, you have a lower mortgage amount. Property tax rates are lower. It's a little bit harder to break through that threshold and itemize. So once again, this type of fee is not necessarily always refundable for everyone. It's really those that have the higher mortgage rates, the higher tax rates, the higher income taxes. Those are the ones that are going to benefit from those deductions. So that's that. So let's kind of play through a scenario here. So we have, let's say, this current loan set up the way it is right here. We have a refi where we're really, in this case, trying to shorten the term. We're trying to go from a 30 to a 15. And we're also trying to go from a lower interest rate. So in this case, 3.625 to, let's just hypothetically say 2.875. In this case, let's say the lender is providing the fees expressed as an APR. In that case, let's just say it's 3.025. That'll compute all these metrics below. And really, this is generating the graph at the bottom, and this is the thing we want to use to try to help inform our decision making. So in this case, we're considering you have sort of two types of assets to balance here. And one is your cash, and the other is the equity in your home. So in this case, your cash is represented by the blue. Your home equity is in the orange. And when you add those two together, you get basically your total equity that you're going to use to evaluate this scenario. In this case, really the line we're using is the gray to make any sort of our decision. So in this case, what it's showing us is that on day zero here, when we originate the loan, there's no delta in our home net equity because it's the same amount. We're refinancing the same amount we have in our current loan. So that doesn't change, but it is costing us, in this case, let's say about $1,900 to execute this refi. So in that case, you see how the blue line sitting here just shy of, these are in thousands, sitting just shy of $2,000 there. That's representing the cost to actually execute the refi. So you're out almost $2,000 in cash to begin with. So now what's going to happen over time compared to your current loan? This interest rate is, substantially less. It's almost a whole percentage point less. You are going to accrue equity, even with the same monthly payment between the two scenarios, at a much faster rate with the refi, really due to the lower interest rate. And that's represented by this net delta in the orange increasing here. So we see it's increasing. Right, so how long is it going to take me to make back this $2,000 it cost me to originate the loan? Well, that's quite easy. You just see where the gray line crosses over the $0 line here, right? And I've tabulated these up here. So just under a year and a half. So I think that's probably a year and 5 months to recoup your refi fees. You'll see here, by basically executing this, if you, let's say, held the loan to maturity, you never moved out of your house or sold it, in the end, you're going to end up saving $14,000 some dollars. And to do so, this will max out at a period of about 16 years. So that's kind of, we're pulling metrics off this gray line here. So it's showing you here in this case, you have a lot to gain if you hold it over a long term. And if you, let's say, plan on living in your house for at least a year and a half, you're going to break even. So that's why I always say it depends when you say, is it good for me to refi? So obviously, if you're going to move in a year from now and you're not going to break even until a year and a half, probably not a good idea. So let's look at a couple other things you can do here. So we can do a cash out refi, right, where I want to borrow more than what I currently owe. So let's just say I want to borrow what my original loan amount was. So I want to effectively cash out $20,000 in my home. I can do this, and of course we're going to see sort of the ensuing metrics move on this chart. So now up front, I get a lot of extra cash compared to what I would currently do with my existing loan without doing anything. So this amount here is really just your $20,000 you've cashed out less your origination fees. Once again, these have scaled up a little bit because we expressed the refi fees as an APR. If it was a fixed amount, I think before it was like $1,900, we could just overwrite it. Small nudge to the graphs. But in this case, it's pretty interesting. You can see you get all the extra cash up front. You're trading that in for equity in your home, right? You're negative $20,000 now there. So conceivably, you could do a project or something with this. That is not factored into this scenario. In this scenario, we assume you're just keeping it as cash. But here you can see it's actually quite interesting. So you break even here at about 3 years in. You peak out in value. This thing offers sort of the best net value by executing the refi in 10 years in a month, I guess, to be exact. And the optimal refi value that you're saving there is $2,500. So in this case, right, if you're living in your house for at least 3 years, maybe it makes sense to do that. There's more mechanics going on in these things in terms of what you're actually going to do with this cash. You may need it for an emergency, but otherwise, I don't think it'd really be wise to just do a cash out refi so you can just put extra money in the bank and not have it do anything. Alternatively, we could do the opposite, right? We could try to get a lower monthly payment by doing a cash in refi. So instead of taking $20,000 out of the house, let's say we have an extra $20,000 on hand to put it into the house. Now these curves look drastically different. We get a big bump in our home equity. Right? It costs us a bunch of money to do that. But now what you're starting to look at is just look at these net values that you're saving, right? So you're bypassing a lot of this interest today by reducing your principal through these, additional equity contributions into your home. So it allows you to save a lot more. So the cash out refis, they make sense under certain scenarios, but you will pay in the long run by doing that because you're going to have larger amounts of interest you're paying, let's say today now, as the principal amount's higher. So that's kind of a quick look at how you could use this spreadsheet to kind of hop around through different scenarios to see kind of where the break even is and how much at most you potentially could save if you're staying in your home long term by executing a refi. But of course in certain conditions, let's just say they try to mask the fees. They do a cash out refi. So you're going to get a bunch of this money out, right? But maybe they really, really jack up the fees. So let's say 3.6% or something excessive, right? They could lie to you and say, hey, you execute this deal with us today, we're going to give you $10,000, right? But you're going to take basically a $20,000 hit to your home equity. We're going to give you $10,000 today to execute this deal, right? Your monthly payment, it may go up a little bit. The period is way shorter. You may save on some interest payments in the long term, but to recuperate these origination fees up front, you'll see that the net total between the equity and the cash here is just always negative. You never cross over. So this would be a horrible deal. But they may try to mask those fees by using the whole APR trick once again. So be real careful, if they're expressing those fees as an APR, make sure those numbers, it's close to what the underlying interest rate is. So that's definitely something to watch out for. Now, I can show you a couple other ways to do this. So we've kind of been punching through these scenarios one at a time and evaluating them. But of course, it'd be really nice to programmatically go through and evaluate tons of these all at once. Well, that's where programming can come in with Python. So I'll show you just an example of kind of what you could do if you wanted to run a bunch of these scenarios at once and compare them all side by side. I'm not going to belabor you with the details of this code, even though it's really cool and exciting. I will just jump to the pretty graphs. Okay, so what you're seeing here, and I apologize if the text is small, of course I didn't reformat my font sizes on my axes, are two things. So all the colors correspond to different interest rates you'd be obtaining on the loan. In this case, it's the current loan balance is 180. I'm refining 180, comparing a 30-year at the 3.625 rate to a 15-year at these individual rates. So every one of these colored lines represents a different rate. And in this case, what we're trying to show is the relationship between the refi fees and the break-even period. So for example, if you wanted to, let's say, break even in a year and a half, if your refi fees were, let's say, about $3,000, that would be achievable with an interest rate on a loan at 2.5%. Right now, if the let's say the rate on the loan goes way up, let's say it's like 3%, which it's hard to tell on this graph, but it looks like it is the shade of purple, which is this line. Notice that the refi fees you have to pay in that case for the break even to still be a year and a half or much smaller, because really you're offsetting a lot of your cost now more into interest. So how does this play into the hands of mortgage brokers? Well, obviously in certain scenarios, this isn't very, good if the interest rates are really high, right? For me to still get my year and a half break even, it would say they would only be able to collect, $900, which may not be very attractive to them, right? They gotta, earn a fair commission. However, if the rates are low, they can still make an offer very attractive to you. All these crossover points here at 1.5 years, represent combinations of interest rates and origination fees that really, in the end, achieve the same goal for the buyer, right? A break even of 1.5 years. So if the rates get really low, they can charge more origination fees, and you end up with the same goal. However, that's only part of the story, right? So ultimately, lower interest rates are going to win in the long term, and that's what this graph at the bottom is going to show. So this is just the break-even point. If you remember from the spreadsheet, the curve continues. Heck, I can just bring it right up here. The break-even point is what is this time, right? But the net value you get generally will increase over time if it's a good deal. And in this case, what will happen generally is that all things being equal, aside of the interest rate, the lower the interest rate, the higher you're going to get up on this curve here for where this peaks out. And that's what this is showing you. So, for example, if, these were all satisfactory loans to me, right? So anything from a 2.5 with nearly $3,000 in origination fees down to a, let's say, what's the brown one? That's too hard of a number to read. We'll just go back to the purple. The purple 3.0 at $1,700 in fees. Now I'm really comparing the blue to the purple. Let's say I stay in my house for a long time, where I'm really working my way up that curve. What this is showing you, what's the net max value I could get out of this? Well, if I take my line down here and draw it onto the blue, it's saying I'm saving myself maybe $22,000. If I do the same with, what was it, the purple one again? If I go to the purple, there's a year and a half's up there. If I go down here, I'm maybe only saving myself $13,000. So I'd much prefer the blue. So in general, for a given break-even period, I would be willing to trade more in origination fees for a lower rate, in the sense that I'm breaking even at the same amount of time in both scenarios. But should I stay longer, I have more to gain at the lower interest rate. So yes, this was quite in depth. I like to overdo it. I don't like your easy answers. Oh yes, you should refi, or no, you shouldn't. You should really take some time to analyze these things before you do them. As you can see, there's sometimes substantial amounts of money sort of at play here by making smart decisions. So anyways, let me know if this was way too over the top for you, or if you followed. I think we're at, wow, 25 minutes. That's pretty intense. All right. Well, anyways, like I said, I will post the spreadsheet. I'll provide a link below if you want to play around with the numbers in there. If you shoot me a message with maybe some of the specifics you're looking at, I can run this Python script on it and generate some pretty pictures for you. All right. We'll see you folks later.